Hello and welcome to this episode of my tutorial video. The subject of this video is financial management. This topic is capital structure, value of firm and financial leverage. And the subtopic is Modigliani Miller model. It's also known as capital structure irrelevance model or capital structure irrelevance theorem. Till early 1980s, economists and corporate finance specialists were confused as regards the conflict among the attitudes and approaches towards the capital structure, cost of capital, dividend policy and valuation of the firm. Why this dilemma? Why this confusion? The reason behind this dilemma and this confusion is the objective of financial management. The ultimate objective of financial management is to maximize the wealth of the equity shareholders. That is to maximize the value of the firm. Maximization of value of the firm means minimization of cost of capital. This means value of the firm is inversely related to cost of capital. That is V, the value of firm, inversely related to K. V is value of firm and K is cost of capital. Now, in order to maximize the wealth of the equity shareholders, that is to maximize the value of the firm, economists and corporate finance specialists took this thing very seriously. That is, what should be the capital structure of the firm? That is, what should be the mix of equity capital and debt capital in the capital structure? Some said that debt capital increases the firm value. Some said debt capital is positively related with firm value up to a certain point, and beyond that point the relation becomes inverse. And some said more the financial leverage, more is the value of the firm. So a bit of confusion prevailed at that time among the economists and corporate finance specialists. In that scenario of confusion and conflict, Modigliani and Miller, both of them are Nobel laureates, came out with fresh air in the corporate finance discourse prevailing at that time. Their postulation was very clear and very simple, that capital structure has nothing to do with determination of firm value. That means they postulated that capital structure is irrelevant in determining the firm value. Correct? Now, Modigliani and Miller considered certain assumptions. What are the assumptions? Number one, perfect capital market. This means full information about all the securities are freely available to the investors. Number two, rational investors. This means investors would act rationally in trade-off between risk and return to maximize their gain, and managers also would work in that direction. Correct? This is called rational investors and management. Number three, no transaction costs. There is no transaction cost of what? Of either selling shares or purchasing shares or borrowing a fund. There is no transaction cost. Next, no bankruptcy costs. There is no bankruptcy cost. What is bankruptcy cost? Administrative, priority claims, then legal and professional fees, etc. These are all bankruptcy costs. That means when a firm is declared bankrupt, then these costs are to be incurred. So there is no such cost in the market. Firms can be grouped into risk classes. That means according to the risk, different firms can be grouped in a particular risk class. No corporate tax. There is no corporate tax in the economy. Next, dividend policy has no impact on cost of capital. Now, what is dividend policy? That means what should be the DP ratio, what should be the retention percentage, etc. So that has nothing to do with cost of capital. That is cost of equity and cost of debt capital. Correct? Next, the last one is firms follow the rigid investment policy. This means the investment policy of the firm is independent of dividend policy. Correct? On the basis of these assumptions, Modigliani and Miller postulated this, and this postulation has two propositions, proposition 1 and proposition 2. Now, what is proposition 1? Proposition 1 states that the value of a firm is equal to expected operating income divided by appropriate discount rate. Value of the firm is equal to expected operating income divided by appropriate discount rate. Now, what is appropriate discount rate? Appropriate discount rate is a rate which is applicable to that particular risk class to which the firm belongs, right? And proposition 2 states financial leverage increases expected EPS, that is expected earnings per share, but it does not increase price of stock. Correct? So these are the two propositions of the postulation as developed by Modigliani and Miller. Now, in this video, we shall focus on proposition 1, and in my next video, I will discuss about proposition 2. Correct? So, this video is on proposition 1. That is, value of the firm is equal to expected operating income divided by appropriate discount rate. That is the discount rate applicable to the risk class to which the company belongs. Right? So, this means V is the value of the firm, V equals to O divided by R. That is equals to D plus E. Now, V equals to value of the firm, O equals to expected operating income, R equals to the appropriate discount rate, yeah. So this rate is determined considering the risk applicable to that company. D equals to market value of debt and E equals to market value of equity. Correct? Modigliani and Miller stated that the profit earning capacity or profitability of an asset is more important than the source of finances of those assets. That means the activity generated, that is the profit generated or cash flow generated by an asset, is of greater importance than how the asset had been financed or has been financed, whether it is financed by equity capital or it is financed by debt capital. It has nothing to do with the profit earning capacity or profitability of the asset, which is of ultimate importance. Correct? Now, I need some space, so I have to erase. So far I have written on the whiteboard. Okay, I have to erase. Yeah. Proposition 1, V equals to O by R equals to D plus E. Proposition 2, financial leverage increases expected earnings per share, not the price of stock. Yeah. So we shall discuss only proposition 1 in this episode. So as I need some space to proceed, I am erasing. So far I have written. Yeah. Now let us consider two firms. One unlevered firm, that is the capital structure of the firm contains only equity capital, and the other one levered firm, that is the capital structure consists of equity as well as debt capital. So this is unlevered firm and this is levered firm. Earnings before interest and tax, EBIT, which is operating income, 150,000 for both the firms, less interest since it is an unlevered firm, this firm is not paying any interest, and this is levered firm, this firm is paying interest, say 60,000. Therefore, EBT, earning before tax, or equity earnings, $150,000 for firm A and 90,000 for firm B. Now cost of equity, say 15% for firm A and 16% for firm B, sorry, for 15% for unlevered firm and 16% for the levered firm. Therefore, market value of equity, this is 1,50,000 divided by 15%, and this is 90,000 divided by 16%. This is equal to let me use calculator. 150,000 divided by 15%, that comes to 10 lakh. And 90,000 by 16%, it comes to 562,500. Correct? Now, cost of debt. This is an unlevered firm, so this firm has no cost of debt. And for the levered firm, the cost of debt be 12%. Therefore, market value of debt unlevered firm has no debt, so no question of market value of debt. And for the levered firm, the market value of debt is interest divided by cost of debt. So 60,000 divided by 12% is equal to 500,000. Okay. Therefore, market value of firm, that is D plus E, for unlevered firm, and 10,62,500 for levered firm. Right? So, value of the levered firm is more than value of the unlevered firm, instead of EBIT of the firms being same. Now, in this stage, Modigliani and Miller introduced the idea of arbitrage. This is the interesting addition in the corporate finance discourse by Modigliani and Miller. Here they introduced the idea of arbitrage. Right? What is arbitrage? Arbitrage means the opportunity to borrow at lower rate and gain at higher rate. That is arbitrage. Now you see, the market value of unlevered firm is low compared to the market value of levered firm. That means the prices of stock of unlevered firm is relatively cheaper than prices of stock of levered firm. In this situation, existing equity shareholders of levered firm would try to arbitrage by selling their stake in the levered firm and purchasing new stakes in the unlevered firm. Suppose a stakeholder with 10%, a shareholder with 10% stake in levered firm is trying to arbitrage. So we get 10% stakeholder of levered firm they would sell out 10% of their stake in L firm. L means levered firm. Correct? Then what they will do? Borrow 10% of debt of the levered firm, of the L firm, at the rate 12%, at the rate of 12%. Then with this fund means the sales proceed of 10% stake in levered firm and borrowed cash from the market at 12% rate of interest. This is the fund. So with this fund, what the stakeholder will do? With this fund, purchase 10% equity in the levered firm. So this is the stakeholders' arbitrage strategy. This is the strategy of the stakeholder when he is going to arbitrage. Now let us see what will happen. Sales proceed of 10% sale of levered share is equal to 10% of this. That means 10% of market value of equity that comes to 56 to 50. Borrowed cash equals to 10% of what is the debt? Market value of the 5 lakh. That is the market value of debt. So borrow 10% of this. So 10% of 500,000 is equal to 50,000. Right? And he will borrow this cash at the rate of 12% interest. Because 12% is the rate of interest the levered firm is paying out. So what is the total fund with the stakeholders? Equals to 56,250 plus 50,000. This comes to 1,06,250. This is the total fund the stakeholder of 10% stakeholder of the levered firm has in his disposal. Now with this fund, the shareholder of levered firm will purchase equity of unlevered firm. Purchase %10 equity. Purchase 10% equity. Correct? Now what is market value? 10 lakh. So he is purchasing 10% of 10 lakh. Equals to 1 lakh. So with the borrowed money and the sales proceed of 10% equity shares in levered company, the stakeholder is purchasing 10% equity of unlevered firm, that is 1 lakh. So purchasing equity worth 1 lakh in the unlevered firm. Purchase 10% equity of unlevered firm. U means unlevered firm. Right? Now, after this purchase, the stakeholder is no longer a shareholder of the levered company. He is now a shareholder of this unlevered company. Now let us compare his earlier income and present income, that is the income before purchase of share of unlevered company and income after purchase of share of the unlevered company. This is old income, that is from levered company, new income from unlevered company. Old income as equity holder of levered company, it is 10% of 90,000, that is the equity earnings. 10% of 90,000 equals to 9,000, right? And now as a shareholder of unlevered firm, what will be his income? 10% of 1,50,000, right? That is the equity earnings in unlevered firm. So his stake is 10%. So he will earn 10% of 1,50,000. Equals to 15,000. Now after purchasing shares of unlevered firm, the shareholder has assumed new liability, that is which is the liability? The liability to pay 12% interest on the borrowed fund, because he has borrowed 50,000 at 12% rate of interest. So he has to pay interest in the new scenario. So less interest. How much? 12% of 50,000. This comes to 6,000. Now see, his income remains the same, but now he has additional cash of 6250. He has excess cash of rupees 6250. Where from it has come? You see, his total fund, that is sales proceed of equity shares of levered firm and borrowed money at 12% rate of interest, is 106,250. That is 1,06,250. This is the total money the stakeholder or the shareholder had in his disposal before going to purchase shares of the unlevered firm. But he has actually paid 1 lakh to purchase 10% shares of unlevered firm. He has purchased 10% equity of the unlevered firm, and that was 10 lakh. So he has paid only 1 lakh out of his total cash of 106,250. So we see that his new income remains same, plus he has additional cash 6250. This is arbitrage. Now he will invest this money to other opportunities and earn return from them. Now, according to Modigliani and Miller, this arbitrage will go on so long as there is difference in market value of the firms. Since market value of the unlevered firm is less than the market value of the levered firm, shareholders of levered firm will try to arbitrage like this gentleman did to purchase shares of unlevered firm. So what will happen? Supply of stock of levered firm will increase because everyone is ready to sell shares of the levered firm. So supply of shares of levered firm will increase. As a result, the market value of the levered firm will fall. On the other hand, since the shareholders of levered firm are demanding shares of unlevered firm, so demand for stock of the unlevered firm will increase. As a result, market value of the unlevered firm will increase. So ultimately a time will come when the value of the unlevered firm will be exactly value of the levered firm, and only then the process of arbitrage will stop. As soon as the market value of the unlevered firm becomes equal to the market value of the levered firm, there is no gain in arbitrage, right? Because market values have become equal. the shareholders of either levered firm or unlevered firm will have nothing to gain by shifting their shares. Correct? So, the inequality of the market values, that is, value of levered firm is not equal to value of unlevered firm. This is a temporary phenomenon. This is a temporary phenomenon. According to Modigliani and Miller, this is a temporary phenomenon. When this happens, arbitrage starts, and when arbitrage continues for some time, this becomes BL becomes equal to VU. Value of levered firm becomes exactly equal to value of unlevered firm, and then arbitrage will stop. That is what Modigliani and Miller tried to explain, that capital structure is irrelevant in determining the value of the firm. Correct? When the values of these firms will become equal, still then their capital structure will remain different. When the values of the market values of the two firms, that is the market value of the unlevered firm and market value of the levered firm, become equal to each other, arbitrage will stop. And this is the equilibrium position according to Modigliani and Miller. So, and what is the equilibrium statement? That identical assets must sell at identical price in an equilibrium situation. That is, when there is equilibrium in the capital market, then all identical assets will sell at same price, irrespective of the source of finance of those assets. Correct? So when Walter and Gordon emphasized on DP ratio and retention percentage respectively, that is, they postulated that dividend policy of a firm does impact the price or value of the firm. Modigliani and Miller, both of them neutralized this idea, and they came out with the postulation that capital structure has nothing to do with the value of the firm. The value of the firm is determined by the expected operating income divided by the appropriate rate of discount, that is the rate of discount applicable to the particular risk category to which the firm belongs, and that is equal to market value, summation of market value of equity and market value of debt. When there is difference between market value of unlevered firm and market value of a levered firm, that is market value of a firm with no debt capital and market value of a firm with debt capital, and both of them having same earning before interest and tax, that is same operating income, then arbitrage will start, because arbitrage would provide gain to the shareholders of the levered firm, because the market value of the unlevered firm is less. So in that inequilibrium position, shareholders of levered firm would be inclined to sell their stake in the levered firm, and with that sales proceed and some borrowed fund at the rate of interest at which the levered firm is paying debt, they will accumulate cash. With that accumulated cash, they will go to purchase shares of unlevered firm because market value of the firm is lower. And this arbitrage process will continue till that time when market value of the unlevered firm becomes equal to market value of the levered firm. As soon as this happens, that is that this equality is established, arbitrage process will stop. So the value of the levered firm and the value of the unlevered firm will ultimately be equal, irrespective of the capital structure. Okay. So this is all about Modigliani and Miller theorem, that is capital structure irrelevance theorem. This theorem is of prime importance in financial management, and this topic is an advanced level, is at some advanced level in the financial management subject. So understanding this demands a little bit of attention and concentration. Okay. And Modigliani-Miller theorem is considered as a fantastic contribution to the corporate finance discourse globally. Both of them are Nobel laureates, and their theorem is universally accepted and is considered one of the strongest corporate finance theories ever made. Right? Yeah. So I think this is enough for this video. Okay. Yeah. As arbitrage goes on, more and more shares of levered firm are available for sales. So supply of stock of levered firm will go up. As a result, price of levered firm's share will come down, and market value of the levered firm will come down. And as more and more shareholders of levered firm will demand shares of unlevered firm, demand for shares of unlevered firm will go up. As a result, price of shares of unlevered firm will go up, because we know when demand for a commodity becomes more than supply, its price goes up. Right? Yeah. So this will go on happening, and the arbitrage process will continue until that point comes when the market value of both the firms become equal. Okay. So I hope you have enjoyed this video. Please do like our channel, please do subscribe our channel, please do send comments, please do send queries. Right? Thank you for watching this video. Goodbye and stay well.